Hey guys, what's going on? It is your favorite mortgage lender. I apologize, it took a little bit of time to jump on. I was wrapping up a few meetings. I want to kind of go over everything with you guys as I had expected today, covering the topic of credit and what is it that you need to know when it comes to credit, and what are some tips that I can give you guys in order to be successful when it comes to obtaining your credit score into a positive manner, and most importantly, having the opportunity to create some secrets and giving you guys an understanding of what are the different types of credits that are currently available to you guys. So starting off the different types of credit out there, there is probably about hundreds of different credit score models that are currently available to different consumers. So I'm sure most of you guys have probably went to a car dealership, obtained a credit card through a credit card vendor, or went to a mortgage company, and the credit score that you're currently looking at was different than what you currently have or what you're looking at through Experian, Equifax, and TransUnion, which are the three credit score bureaus. So a lot of different credit monitoring that's also out there, which is through Credit Karma, Credit Sesame, through Discover credit cards, American Express, and the different types of model. We are going to go over there's 16 different credit scorecards that exist out there today just with FICO, excluding Vantage, and we're going to explain the differences between those two. I do have a very detailed PowerPoint as well that I have available for those of you guys who are watching right now, or those who are going to be watching this later on in the future. You're more than welcome to contact me directly, whether it's via email, my phone number, or directly on social media, and I'll be more than happy to share that information for you personally or any of your clients, okay? So a good majority of the things that are available to you when it comes to the credit score in the mortgage industry. So the mortgage industry, for example, is concerned mainly with how the FICO score model works, okay? And we're gonna go over the specific percentages of how it is that the FICO score model works, and most importantly, we're going to explain as well what is it that we currently look for within different mortgage programs of minimum plateaued credit scores that you must have in regards to obtaining a good credit score to qualify for a mortgage. So once again, when you apply for a mortgage, your score is one of the most major factors. Not only is it your credit score that's impacted, but also how you pay your mortgage if you're looking to refinance, the history of the mortgage payment that you currently have available to you. And in addition, you also have, if there are any negative mortgage accounts you've had in the past, understanding and contacting a mortgage professional to most importantly know what is it that's the minimum plateau threshold you must have in order to transition and be successful. Okay, so the next thing, why is it that your credit score is different than what it is that you have? So a credit score that a consumer pulls, and they may pull themselves, does not include what's called the mortgage industry option score, which is what mortgage lenders and generally mortgage brokers use. You know, a credit score will not be the same as when you go to a car dealership and obtain a car loan. You know, they pull us completely different through what's called an auto industry option score, and this weighs more into the history of how you've currently paid your auto loans, as opposed to the different credit score models that are out there if you're obtaining a credit card as well. Okay, so once again, I mentioned to you guys a good majority of the platforms that mortgage lenders use are generally based off of a FICO score. Now, we've probably heard of this term before, but what is FICO? FICO is also known as the Fair Isaac Corporation. Their credit score model is based from as low as a 300 to an 850 credit score. Okay, their model anywhere between over 680 and above puts you at a good credit score. Anything below puts you at what's called a subprime or subpar credit score. Lenders will judge you when you're currently obtaining a mortgage, most importantly for your interest rate, based off of your credit score, your home type, and your down payment. The higher your credit score, the more of a likelihood of your interest rate being that much more competitive, because you have proven to the mortgage lender that you currently have a commitment to staying on top of your credit, not maxing out your credit cards, and simultaneously keeping a good balance and a payment history between them all. Now, when it comes to your credit score, like I said, the most widely used model is FICO. It is a mathematical based model under what's called the Fair Credit Reporting Act. Lenders and creditors have an obligation to report you every 30 to 45 days in regards to your balances, and most importantly in regards to your payment history. Okay, and there are specific percentages that we're going to cover in regards to what it is that you will have, whether you have a positive score or you have a score that is currently going to need a little bit of assistance to qualify for that credit card, mortgage, or car loan that you're looking to obtain. Okay, so again, your score for FICO is based anywhere from 300 to 850. And I mentioned this before. What are the three scoring bureaus that are out there? And you have what's called Experian, Equifax, and TransUnion. Now, again, these specific bureaus also are not universal. Their scores are going to as well be different. Okay, each one based your information, and they keep a file on you. They have a different sense within their own algorithm in regards to how they report it based on the data that is currently available for them through the credit report agencies. So again, explaining FICO score, credit score may be different within each individual credit score agency. For your FICO score to be calculated, your credit report will be obtained through the bureaus with the creditor. It all depends on how quickly your creditor reports your outstanding balances, and you currently show that whether you're on time or you've made any late payment histories. The accounts, you must have at least one account for a minimum open of 6 months or longer in order to receive a credit score. I run into these situations consistently all the time in the mortgage industries where a consumer advises me that he's looking to apply for a mortgage. He willingly fills out the application and agrees to our terms and policies. And then when we go and take a look at his credit, he actually turns out as what's called non-scorable or not scorable. And one of the main reasons is because he has not had at least one account open within the last 6 months. And if you do not have an account revolving open within the last 6 months, then you will most likely have a not scorable credit score or a zero credit score, because you have now not proven to the credit agencies that you've been having the ability to maintain a credit score and keep them revolving. Okay, so for those of you guys who may be always using cash or whatever the case may be, I highly recommend that you do. If you have a difficulty obtaining an unsecured credit card, your first bet, as always, is to try to get what's called a secured credit card, where you can go to your financial institution and you can actually walk in and literally put cash on the table, anywhere from $300 to $1,000, and they will open for you a line of credit. It's called a secured credit card that will now give you the opportunity to have an account open on your credit score. And then in many instances, if you've kept it for a long time and you've had those balances revolving, what will happen is that creditor will actually convert that secured card to an unsecured credit card as well. Okay, now another one score model that's out there is what's called a Vantage score, and this is one that a lot of different clients use. It's actually started in 2006 in March, and Vantage score is based off of as high as 990 for your credit score. So FICO, I said before, is based off of 850. Your Vantage score is based off of 990. So what does that basically mean? That tells me there is an additional 130 points that you have that fluff between a Vantage score and a FICO score, which means a good majority of the time your Vantage score is going to be significantly higher than your FICO score because of that extra wiggle room of 130 points. In addition, the way they score the individual models and their algorithm is also significantly different than FICO's, where they weigh the payment history, types of accounts, the number of credit inquiries that you have differently than how FICO does it. I would say Vantage score is very, very consumer driven. You know, it's one of the biggest providers, FICO is one of the biggest providers, but Vantage score through Credit Karma, which is what most consumers usually have because it's free, they do a very good job of marketing them. You know, it's a lot different than what a lot of other companies are generally using, okay? And their scores are different. You know, Vantage score, you know, clients with a 700 to 800 credit score is actually considered a C borrower or a C score. B is 800 to 900, and then 900 to 990. So their scores are a lot different. So you'll get that question where, hey, my credit score on Credit Karma is showing a 700. Why are you pulling a 580 or a 600? And it's mainly because of that extra dip of that extra points that you currently don't have accessibility to. So now looking at this, guys, when you have, what are the different scoring models and the different algorithms that they currently look into? When you have a Vantage score, your payment history for Vantage score is weighed at 32% of your score. as opposed to FICO, it's 35%. Vantage's utilization is at 23% as opposed to FICO's 15, which is a huge difference. Now, this is probably one of the biggest factors, which is your balances. So Vantage only hits you with 15% or only calculates you 15% of your balances as opposed to FICO is 30%. Okay, so basically almost a third of your score from FICO is based off of your revolving balances. So a good majority of the time when I have consumers whose balances are slowly coming into effect, or their balances are currently being operated, the reducing of those balances will allow that consumer the opportunity to increase their credit score significantly and give them the opportunity to get that much of a score. And then predominantly the rest are the same. I mean, the recent credit is both at 10%, and then the depth of credit and types of credit, Vantage scores at a 13% as opposed to FICO is at a 10%. Okay, and if we add those percentages up, they all equate to 100%. So again, FICO is 35% for your payment history, 30% for utilization, 15% of your length of history. So you should never close a credit card. Even if you keep it at a zero balance, do not close it, because the second that you close it, you're reducing the number of accounts that you have, you're reducing your history in addition, and you're increasing your utilization. By closing a credit card, you have now hurt yourself, like once again, by reducing your utilization because that balance is no longer available to you. You are in addition also taking a hit in regards to the length of history, especially if it's a car that you've had for a long time, and you're simultaneously also going to be injuring yourself with the balances as they will be increasing. Okay, so again guys, when it comes to the payment history and the utilization, those are two of the most important factors that I advise my clients to keep an eye out for if their credit score becomes a factor that we need to look at. So if you are new to credit, what is it that you can do in order to obtain? So I had advised you guys before, obtaining a secured credit card is probably one of the benefits that one consumer can do in order to go. You simply walk into your bank or an institution or even online nowadays, and you can get what's called a secured credit card. You provide them with your debit card and give them an X amount of what you are looking to put down, and then they will simultaneously be able to open that secured credit card and put it on your credit report. Okay. There is also another tactic that I advise my clients, which is getting added as an authorized user on a family member's account. When you're added as an authorized user on a family member's account, you eliminate the need of having an inquiry on your credit, and you also reap the benefits of getting the payment history added to your credit, and then most importantly, the benefits of the low balance with the available utilization. Okay, so getting added as an authorized user to a family member's card, of course with their consent, gives you that long-standing history, minimum balance. Of course, the card that you want to be added on, you don't want it to be something that's maxed out or something that somebody had just obtained. You want that family member or close relative to be able to have that credit card in very good standing with a low balance, long length of history, and simultaneously willingness to know that you are going to also be obtained a credit card on your own and have the ability and be responsible once again for that debt just as much as they are. Okay, so closing an account, like I said, it does not help. It actually hurts your score, guys. So that's super important. You know, that myth that if you don't use it will hurt consumers, you know, keep it revolving, tank of gas, whatever the case may be. Do your best to not close cards if you don't have the ability. You also have what's called rate shopping. We get this all the time. A lot of consumers have the ability when they're choosing different mortgage lenders, cars, and different vendors for cars, credit cards. You have what's called a rate shopping window, where in reality, the number of mortgage-specific inquiries that you have gives you a 30-day period where it will just count as one inquiry. Okay, the specific calculation is used based off of cutoff dates. I always like to tell my clients you want to kind of stay very careful when you are running your credit numerous times, because your inquiries stay on your credit for 2 years. Okay, so when you have your credit run by multiple lenders, okay, that inquiry will now stay on your credit for up to 2 years. So you want to be extremely mindful of that if your credit score is a factor, and understand not just in regards to your interest rate, but understand what is the level of service and professionalism that you're receiving, whether it's from a lender, car dealership, or a credit card institution that you are now looking to obtain a product from them for an extended length of period of time. So once again, guys, your inquiries like severely impact your score, because if you are a consumer that's consistently shopping, or you're a consumer that runs your credit numerous times, even us as lenders, we have to get what's called a LOX, which is a letter of explanation in regards to every single inquiry that you have on your credit score, and you have to advise us and our underwriting team what is the reason why you had your credit score run numerous times. If you had your credit score run numerous times, you must explain every single inquiry that you have on your credit score, and you have to be able to give that letter of explanation advising if you did open an account or if it's something that you were just shopping for. Okay, people who have generally 6 inquiries or more actually statistically are 8 times more likely to file bankruptcies than those with less inquiries. Okay, that goes to show you of the amount of a risk when you have multiple inquiries on your credit in regards to how that can impact you from the most severe standpoint of filing bankruptcy. And then again, guys, the types of credit. So you want to have a revolving types of history. You don't just want to have just credit cards. You want to wrap them around auto loans, car notes, and installment notes such as a personal loan from a private institution, and then of course the creme of the creme, which is a mortgage. Right? Mortgage is probably one of the strongest types of history that you have, where you have a collateral. You're now guaranteeing your lender, you're paying for that collateral that they're being provided, which is the home, just like a car note. And this will give you guys the opportunity for this credit score algorithm to rate you. Okay, so any credit score that's generally under 600 is normally considered a below credit score, subpar. 600 or 649 is considered a poor credit score. Again, this is based off of the algorithms of what's available online. 650 to 699 is considered a fair credit score. Good credit is usually 700 to 750, and then excellent credit score is 750 and above. Okay, now one of the main benefits in addition is, like I said, when you're obtaining a mortgage, your credit score is a huge factor. I can't tell you guys, I have so many clients looking at the exact same home, putting the exact same down payment with a very similar work history. And then one of the clients can have a 613 credit score and another client can have a 720 credit score. That 613 credit score client actually had to pay $6,000 in order to lock his interest rate at par than that regular consumer who actually got the exact same credit score and received back a credit of $310. So huge difference as to what the impact of your credit score can have when you're obtaining a mortgage. Just like when you're obtaining a car note, your interest rate on a car note can be as low as 2%, 3% with very good credit, and even get an extended term of 72 months or 84 months. And honestly, those consumers who have that subpar credit score in reality do not get those benefits of being able to have extended terms, or most importantly, those who have that poor to below par credit, their interest rate can be as high as 24%, 23% from some of these subprime lenders. And that payment difference can be as much as $300 to $400 a month when it comes to interest alone. So again, guys, just some final tips that I have. I'm sure a lot of us are going to probably watch this video later on and ask a bunch of questions. You're more than welcome to message me directly, as I mentioned, and I can kind of go over some of the PowerPoints that I have presented to us today and answer any additional questions that you may have. But some final tips I want to leave you guys with is make sure you're always paying your bills on time. We saw the level of percentage of how much the credit score bureaus rate that amount of credit. Okay, so paying your bills on time, and if you do have late payments, there are some tactics that you can utilize, such as disputing the credit score. You can have what's called a goodwill letter, where you essentially beg for forgiveness and show that you've been paying on time, and you basically plead that you are going through financial hardship, and that will allow, or at least see if you have the ability in order to get those disputes removed as well when you're getting a mortgage. And then most importantly, have lots of positive credit on your report. Make sure you're using credit for at least 6 months. As I mentioned earlier on the call, you want to keep your balances to a minimum, but you also want to keep the balances at least being utilized, because if they don't and they're closed and you have no revolving credit for 6 months, you're going to be pulled as a non-scorable credit, and that now not able to get a mortgage because I don't know what your payment history is. If you do have open cards, at least 3 preferably, make sure you keep the balances very, very low. I generally advise my clients you want to keep it at that 15% mark. That is where it's going to give you the least amount of a hit towards your score. And you want to try, of course, to get the highest credit limit possible. Okay, when you try to get the highest credit limit possible, the higher your credit limit, no matter if you use it significantly or if you use it very small, the higher your credit limit, the lower your utilization. Keeping it at that benefit of that 15% will give you the opportunity to have a heightened score. If you are new to credit, again, two different options. You can obtain a secured credit card, or you can get yourself added as an authorized user on your credit. And then the last thing is, don't apply for too much credit. We saw that. I believe it was those who have 8 more inquiries are more likely to file for bankruptcy, statistically proven. You want to keep those inquiries to a minimum. Trust the professionals that are not only going to give you the best possible rate, but most importantly, give you that level of education, knowledge, staying committed to any specific timelines that you have in place for your home purchase, and helping you understand how the mortgage, auto loans, or credit card business works, so you have that ability in order to be able to perfect your score and put you in a position to qualify for whatever you need. Thanks guys for tuning in. If you guys have any questions, once again, you're more than welcome to contact me directly, whether it's through private message or email, and I'll be more than happy to get back to you guys. Thanks guys, and I'll catch you guys soon.